But unlike India, where we don't take a lot, now they do, but initially a lot of Indians didn't take EMI or loan payments. So, they used to pay for their house through equity. And, US being obviously the largest economy in the world and being the dollar being the reserve currency of the world. And that is that was one of the main reasons that Fitch downgraded the debt, is that there is no fiscal prudence.
Hello everyone, welcome to Cut the Noise, where we talk about finances and investments and cut the noise and demystify anything that is going on in the market. And today we have with us Abhishek, and we are going to talk about the cutting in the rating of US Treasury bonds.
Okay.
So over to you, Abhishek.
Okay, so thank you for having me, and hopefully we can cut some of the noise around what happened. But basically on August 3rd, Fitch, which is one of the largest rating agencies, cut the rating of the US government sovereign bond from AAA to AA+. Of course, it was a big deal. The last time the US got its rating cut was in 2011, when S&P cut the rating. And US being obviously the largest economy in the world and being the dollar being the reserve currency of the world, this has ramifications globally, but also most importantly, of course, for the US. So they basically, the point that they made is that they said that the fiscal deficit of the US and the fiscal prudence of the US is now just becoming very difficult for anyone to really relate. And I think a lot of it is political, like in all good big economies.
But
there's a lot
I
of
also
politics.
read somewhere that the current GDP of America is equal to the current debt that America has. And isn't that alarming?
It is actually higher. So the current, it's significantly higher. And that is that was one of the main reasons that Fitch downgraded the debt, is that there is no fiscal prudence or around it. So just to put some numbers into context, the current US GDP is approximately $25 trillion, whereas the debt is $33 trillion.
Okay.
So it's 140 odd %, which is one of the highest in the world. Also, at the current rate in which they are adding new debt, this number, which was an eye opener, is they are adding $5.2 billion a day of debt.
Okay.
So by 2050, that number will be $50 trillion of debt, and that is the biggest concern in for the Fitch and for this, and hence the downgrade in the debt.
So what are its repercussions on citizens of USA first, and then on India?
Okay, so the first repercussion is, of course, immediately is on the equity markets, right? And the equity market took a hit. I think given that the S&P had done this 12 years ago, so I remember, because I was in the US when the S&P downgrade happened, the market fell 8 or 9%. This time at least the equity market took it little bit better, and I think people knew this was going to come. I think where it's really made a difference is in the bond yield. So like similar to the India, the government, the US bond yield, which is the most important one people look at, is the 10-year treasury. That is reached about a 20-year high. It's trading at 4.4%. And as a result of that, the mortgage rates have also hit a 20-year high and are at now 7.5%. And like in India, most people's wealth in the US is tied to their house. But unlike India, where we don't take a lot, now they do, but initially a lot of Indians didn't take EMI or loan payments. So, they used to pay for their house through equity. In the US, it's the exact opposite. Everyone has taken a mortgage on their house. So if your mortgage payment, which was about, call it $1,200-$1,300 2 years ago, has gone up to $1,500, your disposable income
is reducing
massively. So then the consumption goes down, and the US economy, about 70% of the US economy is consumption. out of the four important four factors of which determine what a GDP is. So it's really had a negative impact on that. I think for as a result of this, to your next question, Ashish, about the global landscape, all countries hold US treasuries. So those with US treasury rates going up, the mark to market that we hold on those has gone down. And I think for India, there is a bigger issue, which is the currency.
Got it.
So the currency, if you see in India, is now crossed 83 about 2 or 3 days ago. And it is a big problem because India imports all its oil.
Got it.
Right? So the largest import is oil. And as dollar rate, as the rupee depreciates, weakens, the cost that we are paying for the dollar is higher. And that will have a direct negative impact on our own.
The cost of oil is increasing, and hence the
in
cost
rupee
of
terms,
everything else in India, consumption,
will go up.
Transportation,
will
and
go
everything.
up. And you saw last month, I know we talk about tomatoes and onions, and you saw last month inflation was over 7%, which is much higher
which is
than
going
what
to go even further higher.
which will probably go higher given that the political unrest. So the oil market is anyways in a supply-demand imbalance, and now you're adding this pressure of the rupee. So the US being where it sits, that downgrade has a cascading effect all over the world, even for us sitting here because of inflation.
Got it. So that's it. Thank you, Abhishek.
Thank you.
Hopefully we were able to cut the noise around US sovereign bonds. If you still have any questions or doubts, please feel free to comment in the comment section of our videos, and our team will reach out to us. Till that moment, get a grip on your money and go beyond. Thank you.